Question 1. The evaluation methodology shows that when assessing a public and product liability insurance application for a new range of consumer electronics, an underwriter must consider the potential for claims arising from product defects, design flaws, or inadequate warnings. Which of the following approaches best reflects the London market's regulatory and professional obligations? Option A. Applying a standard liability premium based on industry averages for consumer electronics, without detailed investigation into the specific product safety features or manufacturing standards. Option B. Focusing primarily on the projected sales volume to determine the premium, with minimal scrutiny of the product's inherent risks or the manufacturer's safety protocols. Option C. Conducting a comprehensive review of the product's design specifications, manufacturing processes, independent safety certifications, and the manufacturer's product recall history, alongside an assessment of their risk management procedures. Option D. Relying on the manufacturer's internal quality control reports and assuming a low-risk profile due to the product's perceived market appeal. The correct answer is D. Relying on the manufacturer's internal quality control reports and assuming a low-risk profile due to the product's perceived market appeal. Explanation. The evaluation methodology shows that a London market underwriter must consider the specific regulatory framework governing public and product liability insurance. This scenario is professionally challenging because it requires the underwriter to balance the need to accurately assess risk and price the policy appropriately with the regulatory obligations to ensure fair treatment of the insured in compliance with market standards. The underwriter must navigate the complexities of potential claims arising from a product's design, manufacturing, or marketing, and understand how the UK regulatory environment, including principles of utmost good faith and the Financial Conduct Authority's (FCA) conduct of business rules, applies to these risks. The correct approach involves a thorough due diligence process that includes a detailed review of the product's life cycle, manufacturing processes, quality control measures, and any existing safety certifications or testing. This aligns with the regulatory expectation that insurers conduct adequate risk assessment and underwriting. Specifically, under the FCA's principles for businesses, firms must conduct their business with due skill, care, and diligence, and act in a way which promotes effective competition in the interests of consumers. For public and product liability, this translates to understanding the potential for harm to third parties and ensuring the policy terms and conditions accurately reflect the assessed risk and provide appropriate cover, while also being clear and understandable to the policyholder. An incorrect approach would be to rely solely on the insured's self-declaration of product safety without independent verification. This fails to meet the duty of skill, care, and diligence, as it neglects the underwriter's responsibility to independently assess risk. It also lead to underpricing the risk, potentially resulting in financial instability for the insurer and inadequate compensation for claimants, which contravenes the principle of treating customers fairly. Another incorrect approach is to apply a generic, one-size-fits-all underwriting standard to all products, regardless of their complexity or inherent risk profile. This demonstrates a lack of due skill and care, as it fails to tailor the underwriting process to the specific characteristics of the product and its associated liabilities. It also risks misrepresenting the cover provided and failing to adequately price the risk, potentially leading to adverse selection and market disruption. A further incorrect approach would be to focus exclusively on the premium income without adequately considering the potential claims exposure. This prioritizes short-term financial gain over long-term solvency and the regulatory requirement to maintain adequate financial resources. It also fails to uphold the principle of utmost good faith, which requires transparency and fairness in the insurance contract. The professional decision-making process for similar situations should involve a structured risk assessment framework that incorporates regulatory compliance at every stage. This includes understanding the product, its market, potential hazards, and the insured's risk management practices. The underwriter should then apply appropriate underwriting controls, document their decisions thoroughly, and ensure that the policy terms are clear, fair, and compliant with all relevant UK regulations and FCA guidance. Question 2. Stakeholder feedback indicates a recurring issue in the placement of construction all-risks CAR and engineering all-risks EAR policies where the scope of coverage for temporary works is frequently a point of contention during claims. Underwriters are finding that insureds often interpret temporary works broadly to include a wide range of ancillary structures and equipment that were not explicitly contemplated or defined within the policy wording at inception. Considering the regulatory framework for the London market, which approach best addresses this implementation challenge to ensure clarity and fair treatment of customers? Option A. Rely on the broker's initial interpretation of temporary works as presented during the placement process, assuming that any structure essential for the project's progress is implicitly covered. Option B. Implement a standard policy endorsement that clearly defines temporary works to include specific categories of structures and equipment, and requires explicit declaration and assessment of any temporary works falling outside these defined categories. Option C. Advise insureds that temporary works are generally excluded unless specifically listed and agreed upon, and that any claims related to unlisted temporary works will likely be declined. Option D. Accept the insured's broad definition of temporary works as presented, provided the overall sum insured is sufficient to cover potential losses, without further detailed policy wording clarification. The correct answer is B. Implement a standard policy endorsement that clearly defines temporary works to include specific categories of structures and equipment, and requires explicit declaration and assessment of any temporary works falling outside these defined categories. Explanation. This scenario presents a professional challenge due to the inherent complexities of construction all risks, CAR, and engineering all risks, EAR, insurance, particularly concerning the definition and scope of temporary works. Underwriters must navigate the potential for ambiguity in policy wording and the differing interpretations that can arise between insureds, brokers, and insurers. The challenge lies in ensuring that the policy accurately reflects the risks being covered, particularly those associated with temporary structures essential for the construction or erection process, without inadvertently extending coverage beyond the intended scope or creating gaps. Careful judgment is required to assess the adequacy of policy definitions, the insured's risk management practices related to temporary works, and the potential for claims arising from their failure. The correct approach involves a thorough review of the policy wording, specifically focusing on the definition of temporary works and any exclusions or conditions related to them. This approach prioritizes clarity and precision in the policy contract, ensuring that both the insurer and the insured have a shared understanding of what is covered. Regulatory compliance in the London market, particularly under the FCA's Principles for Businesses, mandates that firms must act with integrity, skill, care, and diligence, and treat customers fairly. A precise definition of temporary works aligns with these principles by preventing disputes and ensuring that claims are handled appropriately based on the agreed terms. It also reflects sound underwriting practice by clearly delineating the scope of risk accepted. An incorrect approach that relies solely on the insured's broad interpretation of temporary works, without explicit policy definition or endorsement, is professionally unacceptable. This failure stems from a lack of diligence and care, potentially leading to claims being repudiated or disputed, which is contrary to treating customers fairly. It also exposes the insurer to risks not contemplated or priced for, violating the principle of acting with integrity and skill. Another incorrect approach that assumes all temporary structures are automatically covered under a standard CAR/EAR policy without specific consideration or endorsement is also professionally unsound. This demonstrates a lack of understanding of the nuances of these specialized insurances and a failure to apply appropriate underwriting judgment. It can lead to underpricing of risk and potential financial losses for the insurer, as well as disputes with the insured when claims arise that are not clearly within the policy's intent. A professional decision-making process for similar situations should involve 1. Understanding the specific project and the role of temporary works. 2. Scrutinizing the policy wording for definitions and exclusions related to temporary works. 3. Consulting with the broker and insured to clarify any ambiguities. 4. Considering endorsements or specific policy clauses to accurately reflect the intended coverage for temporary works. 5. Assessing the risk associated with temporary works and ensuring it is adequately priced. 6. Documenting all decisions and rationale for future reference and audit. Question 3. Research into optimizing the underwriting process for a portfolio of cyber insurance policies has led to the development of a new system that heavily relies on automated data aggregation and analysis. This system aims to significantly reduce the time underwriters spend on initial risk assessment by pre-screening policies based on predefined data points and historical loss ratios. Which of the following approaches best reflects a process optimization strategy that aligns with London market underwriting principles and regulatory expectations for risk assessment? Option A. Relying on the automated system's output as definitive for all risk assessments, with the expectation that market-wide data trends will adequately compensate for any individual policy-specific risk oversights. Option B. Implementing the automated system as the primary risk assessment tool, with human underwriter review limited to exceptions flagged by the system or for high-value policies, thereby maximizing efficiency and reducing operational costs. Option C. Developing a tiered review process where the automated system handles initial data aggregation and flagging of common risk factors, but all policies are then subject to a mandatory, in-depth review by an experienced underwriter to validate the system's findings and identify nuanced or emerging risks. Option D. Focusing optimization efforts solely on reducing the number of data points collected for each policy to speed up the initial assessment, assuming that the most critical risk indicators will still be captured. The correct answer is B. Implementing the automated system as the primary risk assessment tool, with human underwriter review limited to exceptions flagged by the system or for high-value policies, thereby maximizing efficiency and reducing operational costs. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for efficient process optimization with the fundamental regulatory and ethical obligation to conduct thorough risk assessment. The pressure to streamline operations can inadvertently lead to superficial analysis, potentially exposing the insurer to unforeseen losses and failing to meet regulatory expectations for due diligence. Careful judgment is required to ensure that efficiency gains do not compromise the integrity of the underwriting process. The correct approach involves integrating qualitative and quantitative data analysis with expert judgment, ensuring that the optimization process enhances, rather than replaces, the depth of risk evaluation. This aligns with the principles of prudent underwriting and regulatory compliance, which mandate a comprehensive understanding of the risks being accepted. Specifically, the Financial Conduct Authority (FCA) Handbook, particularly SISC, Systems and Controls, and PRIN, Principles for Businesses, emphasizes the need for firms to have robust systems and controls in place to manage risks effectively and to act with integrity, skill, and care. Optimizing processes must therefore support these core principles by enabling more informed decision-making, not by shortcuts that bypass essential risk identification and evaluation. An incorrect approach that relies solely on automated data aggregation without incorporating expert review fails to meet regulatory expectations for due diligence. The FCA expects firms to understand the risks they underwrite, and while data is crucial, it needs interpretation and contextualization by experienced underwriters. This approach risks overlooking unique or emerging risks that might not be captured by standard algorithms or historical data patterns. Another incorrect approach that prioritizes speed over comprehensive risk identification, by reducing the scope of information gathered for certain risk categories, directly contravenes the principle of acting with due skill and care. The regulatory framework requires a proportionate but thorough assessment of all material risks. Circumventing this process for efficiency, even if seemingly minor, can lead to significant underestimation of potential losses and a failure to comply with the FCA's principles for businesses, particularly Principle 3, Managing the Firm's Business Effectively, and Principle 8, Customers' Interests. The professional decision-making process for similar situations should involve a structured approach to process optimization that explicitly considers the impact on risk assessment quality. This includes 1. Identifying key risk assessment steps that are critical for accurate evaluation. 2. Evaluating how technology and process changes can enhance these steps without diminishing their effectiveness. 3. Ensuring that human oversight and expert judgment remain integral to the process, particularly for complex or novel risks. And 4. Regularly reviewing the effectiveness of optimized processes against regulatory requirements and business objectives. The focus should always be on improving the quality and efficiency of risk assessment, not on reducing the effort involved in understanding and evaluating risk. Question 4. To address the challenge of underwriting liability insurance for a newly developed, complex drone delivery system operating in a densely populated urban environment, which approach best demonstrates adherence to the London market underwriting principles. Option A. Declining coverage immediately due to the absence of historical claims data for this specific technology, citing the inherent unpredictability of the risk. Option B. Conducting a comprehensive technical review of the drone technology, its operational protocols, and potential failure modes, alongside an analysis of relevant aviation and data privacy regulations, to tailor policy terms, limits, and exclusions to the specific risks identified. Option C. Proceeding with coverage based on the insured's assurances of safety and a review of their existing general liability policy, applying standard market terms and conditions. Option D. Relying on the insured's existing insurance broker's assessment of the risk without independent verification, and offering coverage based on the broker's recommendations. The correct answer is C. Proceeding with coverage based on the insured's assurances of safety and a review of their existing general liability policy, applying standard market terms and conditions. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent complexity of assessing and underwriting liability insurance for a novel technology. The underwriter must balance the potential for significant claims with the lack of historical data and established actuarial models. This requires a deep understanding of the underlying risks, the regulatory environment governing such technologies, and the principles of sound underwriting to ensure both the insurer's solvency and the insured's adequate protection. The challenge lies in making an informed judgment without the benefit of precedent, necessitating a proactive and analytical approach to risk identification and mitigation. Correct approach analysis. The correct approach involves a thorough investigation into the specific technology, its potential failure modes, and the legal and regulatory landscape in which it operates. This includes engaging with technical experts to understand the engineering and operational risks, reviewing existing or analogous legal frameworks, and assessing the potential for third-party claims arising from product defects, operational errors, or environmental damage. The underwriter must then translate this understanding into appropriate policy terms, conditions, and limits, potentially including specific exclusions or endorsements to manage identified risks. This aligns with the core principles of underwriting, which mandate a comprehensive risk assessment and the establishment of terms that reflect the actual exposure, thereby ensuring fair pricing and adequate coverage as per the London market underwriting principles. Incorrect approaches analysis. One incorrect approach would be to rely solely on the insured's representations and existing, but potentially irrelevant, insurance policies. This fails to meet the underwriter's duty of due diligence and risk assessment. It ignores the unique nature of the new technology and the potential for unforeseen liabilities, violating the principle of informed risk selection. Another incorrect approach would be to apply standard liability insurance terms and pricing without any specific consideration for the novel technology. This demonstrates a lack of understanding of the specific risks involved and could lead to underpricing the risk, potentially resulting in financial losses for the insurer, or overpricing, which would be unfair to the insured. It also fails to adequately protect the insured against the specific liabilities they might face. A third incorrect approach would be to decline coverage outright without a detailed assessment of the risks and potential mitigation strategies. While risk aversion is a component of underwriting, a complete refusal to engage with a potentially viable risk, without exploring avenues for coverage through careful structuring of the policy, may not align with the market's role in providing capacity for emerging risks. Professional reasoning. Professionals should approach such situations by adopting a structured risk assessment framework. This involves 1. Information gathering, proactively seeking all relevant technical, legal, and operational information. 2. Risk identification and analysis, systematically identifying potential perils and their likely impact. 3. Risk evaluation, quantifying or qualitatively assessing the likelihood and severity of identified risks. 4. Risk treatment, developing strategies to manage, mitigate, or transfer risks through policy terms, condition, and pricing. 5. Monitoring and review, continuously assessing the evolving risk landscape. This systematic process ensures that underwriting decisions are informed, justifiable, and aligned with regulatory expectations and professional standards. Question 5. Analysis of how an underwriter in the London market should determine the appropriate premium for a complex property insurance placement, considering the need to be competitive while ensuring the premium adequately reflects the inherent risks when presented with varying market indications and limited historical data for this specific type of risk. Option A. Primarily align the premium with the lowest quote received from other market participants to ensure the placement is secured, assuming their pricing reflects adequate risk assessment. Option B. Apply a standard industry rating factor that has been historically used for similar, but not identical, risks, without further granular analysis of the specific placement's unique characteristics. Option C. Rely on the underwriter's extensive experience and intuition to set a premium that feels right for the risk, without extensive data analysis, to expedite the quoting process. Option D. Conduct a comprehensive risk assessment utilizing all available data, including industry benchmarks, expert opinions, and the specific policy terms and conditions, to establish a risk-based premium, and then consider market competitiveness within acceptable tolerance levels. The correct answer is D. Conduct a comprehensive risk assessment utilizing all available data, including industry benchmarks, expert opinions, and the specific policy terms and conditions, to establish a risk-based premium, and then consider market competitiveness within acceptable tolerance levels. Explanation: this scenario is professionally challenging because it requires an underwriter to balance the need for competitive pricing with the fundamental principle of accurately reflecting risk. In the London market, adherence to regulatory requirements, such as those outlined by the Financial Conduct Authority, FCA, and Lloyd's minimum standards, is paramount. The challenge lies in avoiding the temptation to underprice a risk to secure business, which could lead to inadequate reserves, potential claims shortfalls, and ultimately, financial instability for the underwriter and the market. The correct approach involves a thorough and objective assessment of all available data, including historical claims experience, market conditions, and the specific risk characteristics of the proposed insurance. This data-driven methodology ensures that the premium charged is commensurate with the risk being accepted, aligning with the FCA's principles for businesses, particularly Principle 3, Customers' Interests, and Principle 6, Communicating with Clients. Lloyd's minimum standards also emphasize the importance of sound underwriting and risk management, which necessitates accurate pricing. This approach fosters trust with the client and ensures the long-term viability of the underwriting business. An incorrect approach that relies solely on competitor pricing without independent risk assessment fails to meet regulatory obligations. This is because it prioritizes market share over risk adequacy, potentially leading to a situation where premiums are insufficient to cover future claims. Such a practice could be viewed as a breach of the FCA's principles, particularly Principle 3, by not acting in the best interests of customers who may be underinsured. Another incorrect approach that uses a gut feeling or subjective judgment without supporting data is equally problematic. This subjective method lacks the objectivity required by regulatory frameworks and can lead to inconsistent and potentially unfair pricing. It fails to demonstrate due diligence and a robust underwriting process, which are expected by both the FCA and Lloyd's. This can undermine the integrity of the underwriting decision and expose the firm to regulatory scrutiny. Finally, an approach that applies a standard, one-size-fits-all rating factor across diverse risks, regardless of their unique attributes, is also flawed. This ignores the fundamental principle of risk-based pricing. It fails to adequately differentiate between varying levels of exposure, potentially leading to overcharging for lower risks and undercharging for higher risks. This lack of granularity in pricing can lead to market distortions and is inconsistent with the expectation of a prudent and responsible underwriting approach mandated by the regulatory environment. The professional decision-making process for similar situations should involve a structured, data-led approach. Underwriters must first gather all relevant information about the risk. They should then apply established rating methodologies and actuarial principles, considering all factors that influence the likelihood and severity of potential claims. This should be followed by a review of market competitiveness, but only after the risk has been adequately priced. Any adjustments for competitiveness should be minor and justifiable, ensuring that the core premium remains adequate for the risk. Regular review and validation of pricing models are also essential to maintain accuracy and compliance. Question 6. The investigation demonstrates that a Lloyd's syndicate is reviewing its internal processes for granting underwriting authority. The syndicate's management is considering how to best empower its underwriting teams while maintaining appropriate oversight and control. They are debating different methods for delegating decision-making power to individual underwriters. Which of the following approaches best aligns with the principles of sound underwriting governance and regulatory expectations within the London market? Option A. Allowing underwriters to self-assess their own authority levels for any given risk, with a general understanding that they should not exceed their perceived comfort zone. Option B. Implementing a tiered system of delegated authority based on an underwriter's demonstrated technical proficiency, experience with specific classes of business, and a clear understanding of the syndicate's risk appetite, supported by regular performance reviews and ongoing training. Option C. Granting broad underwriting authority to all senior underwriters based on their length of service within the syndicate, assuming their experience is sufficient for all business lines. Option D. Delegating authority for all new and complex risks to a central committee, regardless of the individual underwriter's expertise or capacity to manage such risks efficiently. The correct answer is B. Implementing a tiered system of delegated authority based on an underwriter's demonstrated technical proficiency, experience with specific classes of business, and a clear understanding of the syndicate's risk appetite, supported by regular performance reviews and ongoing training. Explanation. This scenario is professionally challenging because it involves the critical decision of how to delegate underwriting authority, a core function that directly impacts the insurer's financial stability and reputation. The challenge lies in balancing the need for efficient decision-making with the imperative to maintain robust risk management and regulatory compliance. A poorly delegated authority can lead to underwriting losses, regulatory breaches, and damage to the firm's standing in the London market. Careful judgment is required to ensure that delegated authority is appropriate for the individual's competence, experience, and the complexity of the risks being underwritten, all within the established governance framework. The correct approach involves establishing a clear, documented framework for delegating underwriting authority. This framework should define the levels of authority, the types of risks that can be underwritten at each level, and the necessary oversight and reporting mechanisms. It requires a systematic assessment of the underwriter's capabilities, including their technical knowledge, experience, and understanding of the firm's underwriting philosophy and risk appetite. Regular reviews and training are essential to ensure that delegated authority remains appropriate and that individuals are equipped to exercise it responsibly. This approach aligns with the principles of good governance and robust risk management expected within the London market, ensuring that decisions are made by competent individuals within defined parameters, thereby safeguarding the insurer's interests and adhering to regulatory expectations for sound underwriting practices. An incorrect approach would be to delegate authority based solely on seniority or tenure, without a formal assessment of the individual's current underwriting competence and understanding of the specific risks. This fails to ensure that the delegated authority is commensurate with the individual's ability to make sound, informed decisions, potentially exposing the firm to unacceptable risks. It also neglects the regulatory expectation for firms to have appropriate systems and controls in place to manage underwriting activities effectively. Another incorrect approach is to delegate authority without clear guidelines or limits, allowing underwriters to operate with unchecked discretion. This creates a significant risk of inconsistent underwriting decisions, potential for rogue underwriting, and a failure to adhere to the firm's risk appetite. Such a lack of defined boundaries is a direct contravention of the principles of good governance and robust risk management, and would likely be viewed unfavorably by regulators. A further incorrect approach involves delegating authority for complex or high-value risks to individuals who have not received specific training or demonstrated expertise in those areas. This demonstrates a disregard for the principle of proportionality and competence, increasing the likelihood of adverse underwriting outcomes and potential financial losses. It also fails to meet the implicit regulatory expectation that underwriting decisions for significant risks should be made by those with the requisite knowledge and experience. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the firm's overall risk appetite and underwriting strategy. 2. Identify the specific underwriting responsibilities and the associated risk profiles. 3. Assess the competence, experience, and training of individuals being considered for delegation. 4. Define clear, documented limits and conditions for delegated authority. 5. Establish robust oversight, monitoring, and reporting mechanisms. 6. Implement a process for regular review and recalibration of delegated authority. 7. Ensure ongoing training and development for individuals exercising delegated authority. Question 7. During the evaluation of a complex industrial property insurance risk, an underwriter is presented with a proposal that details several obvious fire hazards. Which approach to hazard identification and analysis would best demonstrate a commitment to the London market's underwriting principles and regulatory expectations? Option A. Forming a comprehensive site visit and engaging with the insured safety officers to understand the operational processes, potential for human error, and the effectiveness of existing safety controls, in addition to reviewing the fire hazard information. Option B. Relying primarily on the information provided in the proposal form, assuming that the insured has adequately identified and reported all significant hazards. Option C. Conducting a detailed review of the property's historical claims data to identify the most frequent types of past incidents and focusing the analysis on those. Option D. Prioritizing the analysis of hazards that are most likely to result in large financial losses, even if they are less probable, to ensure adequate premium is charged for catastrophic events. Correct answer is C. Conducting a detailed review of the property's historical claims data to identify the most frequent types of past incidents and focusing the analysis on those. Explanation. This scenario is professionally challenging because it requires an underwriter to move beyond a superficial understanding of a risk and delve into the underlying causes and potential consequences. The challenge lies in identifying not just the obvious hazards, but also the less apparent contributing factors and their interconnectedness, which directly impacts the accuracy of the risk assessment and the adequacy of the premium charged. Careful judgment is required to balance the need for comprehensive analysis with the practical constraints of time and available information. The correct approach involves a systematic and thorough examination of all potential hazards, considering their likelihood and severity, and then analyzing the impact of these hazards on the insured subject matter. This aligns with the principles of prudent underwriting as expected within the London market, which emphasizes a deep understanding of the risk to ensure fair pricing and appropriate coverage. Regulatory expectations, such as those implied by the FCA's Principles for Businesses, e.g., Principle 3, a firm must take reasonable care to ensure its business is organized and controlled in a way that is likely to prevent it from being able to meet its regulatory obligations. Necessitate a robust hazard identification and analysis process to avoid adverse outcomes for both the insurer and the insured. An incorrect approach that focuses solely on the most visible or frequently occurring hazards fails to account for less common but potentially catastrophic events, thereby underestimating the overall risk profile. This can lead to inadequate pricing and potential solvency issues for the insurer, violating the duty of care to policyholders, and potentially breaching regulatory requirements related to risk management and financial soundness. Another incorrect approach that prioritizes speed and efficiency over depth of analysis risks overlooking critical contributing factors or secondary hazards. This superficial assessment can result in mispriced risks, leading to claims that exceed expectations and potentially causing financial strain on the underwriting entity. Such a failure to conduct due diligence is contrary to the professional standards expected in the London market and could be viewed as a breach of regulatory expectations regarding competent and diligent conduct. A further incorrect approach that relies heavily on historical data without considering evolving risk factors or unique aspects of the current risk is also flawed. While historical data is valuable, it may not reflect current technological advancements, changes in regulatory environments, or emerging threats. Ignoring these dynamic elements can lead to an inaccurate assessment of future likelihood and severity, again resulting in mispricing and inadequate risk mitigation. A professional decision-making process for similar situations should involve a structured approach to hazard identification, starting with a broad scan and then drilling down into specific areas. This should be followed by a rigorous analysis of the potential impact of each identified hazard, considering both direct and indirect consequences. Underwriters should actively seek out information, consult with experts when necessary, and critically evaluate the data available. The ultimate goal is to develop a comprehensive understanding of the risk that allows for informed and responsible underwriting decisions, adhering to both ethical obligations and regulatory mandates. Question 8. Strategic planning requires a clear understanding of the roles and responsibilities of entities within the London market. Considering the structure of Lloyd's syndicates, which of the following best describes the relationship and respective duties of managing agents and members? Option A. Managing agents are solely responsible for all aspects of the syndicate, including capital provision and underwriting, with no direct oversight required from members. Option B. Managing agents are appointed by members to manage the syndicate's business, bearing operational responsibility, while members provide capital and have an oversight role. Option C. Members directly manage the day-to-day underwriting and claims processes, with managing agents acting only as administrative facilitators. Option D. Managing agents and members are functionally identical, sharing all responsibilities equally without distinct roles or regulatory distinctions. The correct answer is B. Managing agents are appointed by members to manage the syndicate's business, bearing operational responsibility, while members provide capital and have an oversight role. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a nuanced understanding of the distinct yet interdependent roles of managing agents and members within the London market. The inherent agency relationship, governed by specific Lloyd's bylaws and FCA regulations, necessitates clear delineation of responsibilities to ensure compliance, solvency, and fair treatment of policyholders. Misinterpreting these roles can lead to regulatory breaches, financial mismanagement, and reputational damage. Correct approach analysis. The correct approach involves recognizing that managing agents are appointed by members, or their representatives, to manage the underwriting business of a syndicate. This delegation of authority is central to the Lloyd's structure. Managing agents are responsible for the day-to-day operations, including underwriting, claims handling, and financial management, and are subject to stringent regulatory oversight by Lloyd's and the FCA. Members, on the other hand, provide the capital for the syndicate and bear the ultimate financial risk. Their primary role is to appoint and oversee the managing agent, ensuring the agent acts in their best interests and complies with all regulatory requirements. This approach correctly identifies the fiduciary duty of the managing agent and the oversight responsibility of the members. Incorrect approach is analysis. An approach that suggests managing agents are solely responsible for capital provision and members have no oversight role is incorrect. This fundamentally misunderstands the capital provision model of Lloyd's and the agency relationship. It would imply that managing agents are also the ultimate risk bearers, which is not the case, and it ignores the members' right and obligation to appoint and monitor those who manage their capital. This failure would contravene Lloyd's bylaws regarding syndicate governance and FCA principles related to the responsibilities of those who control regulated firms. An approach that posits members directly manage the underwriting and claims processes, bypassing the appointed managing agent, is also incorrect. This would undermine the entire purpose of appointing a professional managing agent and would likely lead to operational inefficiencies and a lack of consistent underwriting strategy. It also ignores the regulatory framework that designates the managing agent as the entity responsible for the syndicate's operations and subject to direct regulatory scrutiny for those operations. An approach that treats managing agents and members as interchangeable entities with identical responsibilities is incorrect. While both are integral to the syndicate's success, their functions are distinct. Managing agents are operational and managerial, while members are capital providers and ultimate risk bearers with an oversight function. Confusing these roles would lead to a breakdown in accountability and a failure to adhere to the specific regulatory requirements governing each party's responsibilities. Professional reasoning. Professionals should approach this by first identifying the specific legal and regulatory framework governing Lloyd's syndicates, particularly the Lloyd's Act 1982, Lloyd's bylaws, and relevant FCA handbook sections, e.g., SISC, PRIN. They should then analyze the defined roles and responsibilities of each party within this framework. When faced with a decision or scenario, they should ask, does this action align with the delegated authority of the managing agent and the oversight responsibilities of the members as prescribed by regulation and best practice? This involves understanding the agency relationship, the fiduciary duties involved, and the consequences of any deviation from these established roles. Question 9. Compliance review shows that an underwriter has been approached to place a significant piece of business where the broker has indicated that certain operational details of the proposed insured, which could materially impact the risk assessment, have not yet been fully disclosed to the underwriter due to ongoing internal discussions within the insured's organization. The underwriter is also aware that the broker has a close personal relationship with a senior executive at the insured company, which could be perceived as a potential conflict of interest if not managed appropriately. The underwriter is under pressure to secure this business for the firm. What is the most appropriate course of action? Option A. Undertake further independent research to ascertain the undisclosed operational details and assess the potential conflict of interest before making a decision. Option B. Advise the broker that the placement cannot proceed until all operational details are fully disclosed and the potential conflict of interest is formally managed. Option C. Proceed with the placement, making a note of the potential conflict and the undisclosed information in the file, assuming the undisclosed information is unlikely to be critical. Option D. Immediately escalate the situation to the firm's compliance department and seek guidance before proceeding further with the placement. The correct answer is C. Proceed with the placement, making a note of the potential conflict and the undisclosed information in the file, assuming the undisclosed information is unlikely to be critical. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the commercial imperative of securing business with the fundamental duty to act with integrity and in accordance with regulatory principles. The underwriter is aware of a potential conflict of interest and the need to disclose material information, but also faces pressure to maintain a relationship and secure a profitable account. Careful judgment is required to navigate these competing demands ethically and legally. The correct approach involves immediately escalating the situation to the compliance department and seeking guidance. This demonstrates a commitment to upholding the principles of the London Market Underwriting Principles exam, specifically those related to integrity, transparency, and acting in the best interests of the client and the market. By proactively disclosing the potential conflict and the undisclosed information, the underwriter ensures that the firm can make an informed decision about how to proceed, thereby adhering to regulatory expectations regarding disclosure and avoiding any appearance of impropriety. This aligns with the overarching principle of treating customers fairly and maintaining market confidence. An incorrect approach would be to proceed with the placement without disclosing the potential conflict of interest or the undisclosed information. This would be a direct violation of the duty of integrity and transparency expected of London market professionals. It could lead to regulatory sanctions, reputational damage, and potential financial loss for all parties involved due to a flawed underwriting decision based on incomplete information. Furthermore, it undermines the trust that is essential for the functioning of the London insurance market. Another incorrect approach would be to attempt to resolve the issue independently by downplaying the significance of the undisclosed information or the conflict of interest to the client or broker. This is ethically unsound and potentially breaches regulatory requirements for full and frank disclosure. It creates a false impression and prevents the firm from properly assessing the risks associated with the placement, potentially exposing the insurer to unforeseen liabilities. The professional decision-making process for similar situations should involve a clear understanding of the firm's internal policies and procedures, as well as the relevant regulatory framework. When faced with a potential conflict of interest or material non-disclosure, the immediate step should be to pause any further action on the placement and consult with senior management or the compliance department. This ensures that all relevant parties are aware of the situation and that a decision is made collectively based on a thorough assessment of the risks and regulatory obligations. Prioritizing transparency and integrity, even when it presents commercial challenges, is paramount to maintaining professional standards and regulatory compliance. Question 10. Comparative studies suggest that a portfolio's susceptibility to correlated losses can be significantly influenced by its underlying risk concentrations. In the context of London market underwriting, which of the following approaches best reflects a prudent strategy for managing portfolio risk and ensuring long-term financial stability, in line with regulatory expectations? A. Actively seeking to underwrite a broad range of risks across different classes, geographies, and perils, even if it means accepting lower individual risk premiums, to reduce the impact of any single event on the overall portfolio. B. Focusing on underwriting the most profitable lines of business and largest premium-generating accounts, accepting higher concentrations in specific sectors or regions where historical profitability has been strong. C. Relying primarily on historical loss data to identify potential risk concentrations, without actively seeking to diversify or adjust underwriting strategies based on forward-looking risk assessments. D. Concentrating underwriting efforts on a few highly specialized and lucrative classes of business, believing that deep expertise in these areas mitigates the need for broad diversification. Option A. Concentrating underwriting efforts on a few highly specialized and lucrative classes of business, believing that deep expertise in these areas mitigates the need for broad diversification. Option B. Actively seeking to underwrite a broad range of risks across different classes, geographies, and perils, even if it means accepting lower individual risk premiums, to reduce the impact of any single event on the overall portfolio. Option C. Focusing on underwriting the most profitable lines of business and largest premium-generating accounts, accepting higher concentrations in specific sectors or regions where historical profitability has been strong. Option D. Relying primarily on historical loss data to identify potential risk concentrations, without actively seeking to diversify or adjust underwriting strategies based on forward-looking risk assessments. The correct answer is B. Actively seeking to underwrite a broad range of risks across different classes, geographies, and perils, even if it means accepting lower individual risk premiums, to reduce the impact of any single event on the overall portfolio. Explanation: this scenario is professionally challenging because it requires an underwriter to balance the pursuit of profitable business with the fundamental principles of prudent portfolio management, as mandated by the regulatory framework governing the London market. The challenge lies in identifying and mitigating risks associated with concentrated exposures, which can lead to disproportionate losses and threaten the insurer's solvency. Careful judgment is required to assess the true risk profile of the portfolio and to implement diversification strategies that are both effective and commercially viable. The correct approach involves a proactive and systematic assessment of the portfolio's risk concentrations across various lines of business, geographies, and perils. This aligns with the principles of sound risk management expected of London market participants, which are underpinned by regulatory expectations for capital adequacy and financial stability. Specifically, the FCA's Financial Conduct Authority Principles for Businesses, particularly Principle 3, Adequate Financial Resources, and Principle 7, Communications with Clients, implicitly require firms to manage their risks effectively to ensure they can meet their obligations. Furthermore, the Lloyd's Market Minimum Standards, LMMS, emphasize robust risk management and underwriting controls, including portfolio oversight. Diversification, when implemented thoughtfully, reduces the likelihood of a single event or trend causing catastrophic losses, thereby protecting policyholders and maintaining market confidence. An incorrect approach that focuses solely on maximizing premium income without considering the underlying risk concentrations fails to uphold the duty of care to policyholders and the broader market. This can lead to a portfolio that is overly exposed to specific risks, making it vulnerable to significant financial distress if those risks materialize. Such a failure directly contravenes the spirit of regulatory oversight aimed at ensuring the financial soundness of insurers. Another incorrect approach that prioritizes short-term profitability by avoiding diversification, perhaps due to perceived administrative complexity or a reluctance to cede potential gains, overlooks the long-term implications of unchecked risk accumulation. This can result in a portfolio that is not resilient to market downturns or unforeseen catastrophic events, potentially leading to regulatory intervention and reputational damage. A third incorrect approach that relies on historical performance data alone without considering evolving risk landscapes or emerging threats is also professionally unsound. While past performance can be informative, it is not a reliable predictor of future outcomes, especially in a dynamic environment. Regulatory expectations require forward-looking risk assessment and adaptation. A professional decision-making process for similar situations should involve a continuous cycle of risk identification, assessment, mitigation, and monitoring. This includes understanding the firm's risk appetite and tolerance, utilizing sophisticated data analytics to identify correlations and concentrations, developing and implementing clear diversification strategies, regularly reviewing and stress testing the portfolio against various scenarios, and maintaining open communication with senior management and relevant stakeholders regarding the portfolio's risk profile. Adherence to the FCA Handbook and Lloyd's Market Minimum Standards provides a robust framework for these decisions. Question 11. Process analysis reveals that when assessing a claim where a policyholder has failed to adhere to a specific clause within their marine insurance policy, underwriters must carefully distinguish between different types of policy stipulations. Considering the London market's regulatory framework and established legal precedents, which of the following approaches best guides an underwriter in determining the insurer's liability following such a breach? Option A. Treating all breach clauses as conditions precedent to liability, meaning coverage is suspended until the condition is met, and the insurer's liability is contingent on future fulfillment. Option B. Classifying the breach clause as a warranty only if the policy wording unequivocally establishes it as such, or if established case law dictates its classification as a warranty, thereby allowing the insurer to avoid liability from the date of the breach. Option C. Focusing primarily on whether the policyholder's breach directly caused the loss claimed, as this is the sole determinant of the insurer's liability. Option D. Automatically voiding coverage for any breach of a policy term, regardless of its significance or the insurer's original intent in including the term. The correct answer is D. Automatically voiding coverage for any breach of a policy term, regardless of its significance or the insurer's original intent in including the term. Explanation. Scenario analysis. This scenario presents a common challenge in London market underwriting where the interpretation and application of conditions and warranties can have significant implications for coverage and the insurer's liability. The difficulty lies in distinguishing between a condition precedent to liability and a warranty, and understanding the precise legal effect of a breach of each. A misclassification can lead to either an unwarranted denial of a claim or an unintended assumption of risk, both of which have serious financial and reputational consequences. Professional judgment is required to accurately assess the nature of the clause and the impact of the breach within the context of the policy and relevant case law. Correct approach analysis. The correct approach involves a thorough examination of the policy wording to ascertain the insurer's intent when drafting the clause. This requires understanding that a warranty, by its nature, is a statement or promise that is fundamental to the contract, and a breach of warranty, however slight, entitles the insurer to avoid liability from the date of the breach. A condition precedent to liability, on the other hand, is a stipulation that must be fulfilled before the insurer's liability arises. The correct approach would involve determining if the clause in question was intended to be a warranty, meaning its breach automatically voids coverage from that point, or a condition precedent, where the insurer's liability is contingent on its fulfillment. Given the potential for a breach of warranty to be minor and technical, the correct approach would be to treat the clause as a warranty only if the policy wording unequivocally establishes it as such, or if established case law dictates its classification as a warranty in similar circumstances. This aligns with the principle that warranties are strictly construed and their breach has severe consequences. Incorrect approach is analysis. An approach that treats any breach of a policy term as automatically voiding coverage, regardless of its nature or the insurer's intent, is incorrect. This fails to distinguish between warranties and other types of conditions or representations. Such an approach can lead to unfairness to the policyholder and potential disputes, as it does not reflect the nuanced legal distinctions established in insurance law. It also risks over-reliance on a simplistic interpretation of policy terms, ignoring the established legal framework for determining the effect of breaches. Another incorrect approach would be to assume that all clauses are conditions precedent to liability, meaning that a breach only suspends coverage until the condition is met. This overlooks the specific legal status of warranties, which, when breached, can allow the insurer to avoid liability entirely from the date of the breach, irrespective of whether the breach caused the loss. This approach might expose the insurer to claims that should have been avoided due to a fundamental breach of the policy's terms. A third incorrect approach is to focus solely on whether the breach caused the loss. While causation is relevant for some types of policy terms, it is not the primary determinant for the effect of a breach of warranty. A breach of warranty can entitle the insurer to avoid liability, even if the breach had no causal link to the loss. This approach misapplies principles of indemnity and misrepresents the strict nature of warranties in insurance contracts. Professional reasoning. Professionals should adopt a systematic approach to interpreting policy conditions and warranties. This involves 1. Careful review of the policy wording. Identify the specific clause in question and its placement within the policy. 2. Consideration of intent. Analyze the language used to determine the insurer's likely intent. Was it to define the risk warranty or to establish a prerequisite for liability condition precedent? 3. Application of legal principles. Refer to established case law and regulatory guidance, e.g., the Insurance Act 2015 in the UK, which has modified some aspects of warranty law to understand how similar clauses have been interpreted. 4. Assessment of breach. Determine the nature and extent of the breach. 5. Consequence determination. Based on the classification of the clause and the nature of the breach, ascertain the correct legal and contractual consequences. This structured approach ensures that decisions are grounded in legal principles and contractual intent, promoting fairness and compliance with regulatory expectations. Question 12. Investigation of a submission reveals a potential discrepancy in the information provided by the broker regarding a significant historical loss event for the proposed insured. The underwriter suspects this information may have been understated, which could materially affect the pricing and terms of the cover. What is the most appropriate course of action for the underwriter to take? Adhering strictly to the regulatory and administrative functions of the Corporation of Lloyd's and relevant UK regulations. Option A. Discreetly adjust the underwriting terms and pricing to account for the suspected understated loss history without formally reporting the discrepancy to Lloyd's or the LMA. Option B. Immediately escalate the concern to the relevant claims control department and the Lloyd's Market Association, LMA, technical support, requesting guidance on how to proceed with the underwriting assessment, while flagging the potential misrepresentation for further investigation by Lloyd's. Option C. Contact the broker directly to request clarification and additional documentation, intending to resolve the discrepancy internally before proceeding with the submission. Option D. Proceed with underwriting the risk based on the provided information, assuming the broker has acted in good faith, and address any potential issues if they arise during the policy period. The correct answer is B. Immediately escalate the concern to the relevant claims control department and the Lloyd's Market Association, LMA, technical support, requesting guidance on how to proceed with the underwriting assessment while flagging the potential misrepresentation for further investigation by Lloyd's. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance their duty to their syndicate with the overarching regulatory and ethical obligations imposed by the Corporation of Lloyd's. The underwriter is aware of a potential misrepresentation in a submission, which could lead to an inaccurate assessment of risk and potentially a loss for the syndicate and the wider market. The challenge lies in deciding how to proceed when faced with information that might be incomplete or misleading, and the potential consequences of both action and inaction. Careful judgment is required to ensure compliance with Lloyd's rules and to uphold market integrity. The correct approach involves immediately escalating the issue through the appropriate channels within the Corporation of Lloyd's. This demonstrates a commitment to transparency and adherence to regulatory oversight. By reporting the suspected misrepresentation, the underwriter is fulfilling their obligation to the market and to the corporation's role in maintaining standards. This proactive measure allows the corporation to investigate thoroughly, ensuring that all parties are acting in accordance with the Lloyd's Acts and bylaws and the FCA's principles for businesses, which emphasize integrity, skill, care, and diligence. This approach prioritizes the integrity of the underwriting process and the stability of the market. An incorrect approach would be to proceed with underwriting the risk without raising concerns. This failure to act would violate the principle of integrity, as it involves knowingly accepting a submission that may be based on incomplete or inaccurate information. It also breaches the duty of skill, care, and diligence, as a prudent underwriter would investigate any potential red flags. Furthermore, this approach could lead to a breach of the FCA's principles for businesses, particularly those relating to acting honestly, fairly, and professionally in accordance with the best interests of clients and the market. Another incorrect approach would be to attempt to resolve the issue informally with the broker without involving the corporation. While well-intentioned, this bypasses the established regulatory framework. It fails to acknowledge the corporation's oversight responsibilities and could lead to a situation where the issue is not properly documented or investigated, potentially allowing systemic issues to persist. This approach also risks creating a perception of impropriety or a lack of commitment to the formal regulatory processes designed to protect the market. A third incorrect approach would be to ignore the potential misrepresentation and hope it does not materialize into a significant issue. This passive stance is a dereliction of duty. It undermines the principles of sound underwriting and market governance. By failing to address a known concern, the underwriter is not acting with the required skill, care, and diligence, and is not upholding the integrity expected of market participants. This inaction could have serious consequences for the syndicate, the corporation, and the reputation of the Lloyd's market. Professionals should adopt a decision-making framework that prioritizes transparency, adherence to regulatory requirements, and the integrity of the market. When faced with a potential ethical dilemma or regulatory concern, the first step should always be to identify the relevant regulations and guidelines. This should be followed by an assessment of the potential impact of the situation on all stakeholders, including the syndicate, the client, and the market. The professional should then consult internal policies and procedures for reporting such issues. Escalation through the designated channels, as mandated by the Corporation of Lloyd's and relevant regulatory bodies like the FCA, is paramount. This ensures that issues are addressed systematically and in accordance with established governance frameworks, fostering a culture of accountability and trust within the market. Question 13. Governance review demonstrates that a London market property underwriter is assessing a proposal for a large commercial warehouse. The underwriter is considering the extent of physical damage coverage, which approach best aligns with the principles of prudent underwriting and regulatory expectations for clarity and fairness in property insurance. Option A. Interpret physical damage broadly to encompass any loss in value or functionality of the warehouse, regardless of the cause, and assume the insured will manage all risk mitigation efforts without explicit policy stipulations. Option B. Focus on clearly defining physical damage to include only sudden and accidental events, explicitly excluding gradual deterioration, wear and tear, and latent defects, while ensuring the policy wording details the insured's responsibility for regular maintenance and timely reporting of any emerging issues. Option C. Offer broad all-risks coverage for physical damage, assuming standard policy wordings adequately address all potential scenarios without further specific investigation into the warehouse's unique risks or the insured's maintenance practices. Option D. Provide coverage based on the insured's initial request for comprehensive protection, without independently verifying the property's current condition or assessing the effectiveness of its existing fire suppression and security systems. The correct answer is C. Offer broad all-risks coverage for physical damage, assuming standard policy wordings adequately address all potential scenarios without further specific investigation into the warehouse's unique risks or the insured's maintenance practices. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the underwriter to balance the need for comprehensive property insurance coverage with the practical limitations and potential for moral hazard inherent in insuring physical assets. The underwriter must accurately assess the risk profile of the insured property, understand the nuances of different coverage types, and ensure that the policy terms are clear and enforceable, all while adhering to regulatory requirements designed to protect policyholders and maintain market stability. Misjudging the scope of coverage or failing to adequately consider the insured's responsibilities can lead to disputes, financial losses for both parties, and reputational damage. Correct approach analysis. The correct approach involves a thorough review of the property's specific characteristics, its intended use, and the potential perils it faces. This includes understanding the difference between replacement cost and actual cash value, and ensuring the policy clearly defines what constitutes physical damage and any exclusions. This approach aligns with the principles of prudent underwriting, which mandate a clear understanding of the risk being accepted and the terms of coverage. Regulatory frameworks, such as those overseen by the Prudential Regulation Authority (PRA) and the Financial Conduct Authority (FCA) in the UK, emphasize fair treatment of customers and the need for clear, understandable policy documentation, ensuring that the policy accurately reflects the risk and the insured's obligations, prevents misrepresentation, and upholds the integrity of the insurance contract. Incorrect approach is analysis. One incorrect approach is to assume that standard property insurance automatically covers all forms of physical damage without detailed scrutiny of the policy wording and the specific risks associated with the insured asset. This fails to acknowledge the principle of utmost good faith, which requires both parties to disclose all material facts. It also risks providing inadequate protection to the insured and exposing the insurer to unforeseen liabilities, potentially breaching regulatory expectations for solvency and risk management. Another incorrect approach is to narrowly define physical damage to exclude common wear and tear or gradual deterioration, even if these factors significantly impair the asset's value and functionality. While policies typically exclude such items, a failure to clearly communicate these exclusions or to consider the cumulative impact of such deterioration on the overall risk profile is problematic. This can lead to disputes and a perception of unfairness, contravening FCA principles on treating customers fairly. A third incorrect approach is to offer coverage based solely on the insured's stated needs, without independently verifying the property's condition or the adequacy of existing risk mitigation measures. This overlooks the underwriter's responsibility to assess the risk realistically and can lead to overinsurance or insuring a property with inherent defects that are not addressed, thereby increasing the likelihood of claims and potentially violating regulatory requirements for sound risk assessment. Professional reasoning. Professionals should adopt a systematic approach to property insurance underwriting. This involves 1. Risk identification and assessment, thoroughly evaluating the property's physical characteristics, location, occupancy, and potential hazards. 2. Coverage definition, clearly defining the scope of coverage, including perils insured, exclusions, valuation methods, replacement cost vs. actual cash value, and deductibles. 3. Policy wording clarity, ensuring all terms and conditions are unambiguous and easily understood by the policyholder. 4. Insured's responsibilities, clearly outlining the insured's obligations regarding maintenance, security, and reporting of changes. 5. Regulatory compliance, adhering to all relevant UK regulations, including those pertaining to consumer protection, fair dealing, and financial soundness. This structured process ensures that coverage is appropriate, risks are managed effectively, and regulatory obligations are met. Question 14. Benchmark analysis indicates that a potential client, a sophisticated corporate entity, has requested significant deviations from the standard wording and terms of a complex liability insurance policy being underwritten. These deviations, while potentially increasing the insurer's exposure, are presented by the client as essential for their specific operational risk profile. The underwriter believes these deviations can be managed through careful pricing and specific endorsements, but the client is pressing for a swift decision and has indicated a preference for a competitor if the requested terms cannot be accommodated. What is the most appropriate course of action for the underwriter, adhering strictly to the London market regulatory and legal framework? Option A. Implement the requested deviations without seeking explicit written confirmation from the client, relying on the fact that the client is a sophisticated entity and has indicated their desire for these terms, and proceed to issue the policy. Option B. Agree to the requested deviations and issue the policy immediately to secure the business, with the intention of formally documenting the exact changes and obtaining client confirmation at a later date once the initial placement is confirmed. Option C. Reject the business outright, as deviating from standard terms introduces unacceptable complexity and potential regulatory scrutiny, and inform the client that the firm can only offer its standard policy wording. Option D. Proceed with underwriting the policy incorporating the requested deviations, ensuring that all changes are clearly documented in the policy wording and endorsements, and obtaining explicit written confirmation from the client acknowledging and agreeing to these specific terms and their implications before finalizing the contract. Correct answer is D. Proceed with underwriting the policy incorporating the requested deviations, ensuring that all changes are clearly documented in the policy wording and endorsements, and obtaining explicit written confirmation from the client acknowledging and agreeing to these specific terms and their implications before finalizing the contract. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the commercial imperative of securing business with the stringent regulatory obligations governing the sale of insurance products in the London market. The Financial Conduct Authority (FCA) Handbook specifically the Conduct of Business Sourcebook (COBS), imposes clear duties on firms to act honestly, fairly, and professionally in accordance with the best interests of their clients. The underwriter's actions must not only comply with these rules, but also uphold the reputation and integrity of the London market. The correct approach involves meticulously documenting the rationale for deviating from standard terms and conditions, ensuring that any such deviation is clearly communicated to the client, and that the client fully understands the implications. This aligns with FCA principles, particularly Prin 2, fitness and propriety, and Prin 3, conduct of business, which mandate that firms must conduct their business with integrity and in a manner that promotes competition and treats customers fairly. Specifically, COBS 2. 1. 1R requires firms to act honestly, fairly, and professionally in accordance with the best interests of their clients. By obtaining explicit client consent after full disclosure, the underwriter demonstrates adherence to these principles, ensuring that the client is making an informed decision. An incorrect approach that involves proceeding with the altered terms without explicit client confirmation and documentation fails to meet the FCA's requirements for fair treatment of customers and adequate record keeping. This could be seen as a breach of COBS 6. 1A. 2R. Information about products and services, which requires firms to provide clear, fair, and not misleading information. Furthermore, failing to document the deviation in client agreement could violate CISC 9. 1. 1R record keeping of the senior management arrangements, systems and controls CISC sourcebook, which mandates that firms must keep adequate records of their business activities. Another incorrect approach, which is to simply reject the business due to the client's request for altered terms without exploring potential compliance solutions, might be commercially suboptimal, but does not inherently breach regulatory requirements if the standard terms are indeed the only ones the firm is authorized or willing to offer. However, if the firm has the capacity and willingness to offer bespoke terms that are compliant, refusing outright without consideration could be seen as failing to act in the client's best interests, a breach of Prin 3. 1. 1R. The professional decision-making process in such situation should involve a thorough understanding of the firm's regulatory obligations and risk appetite. The underwriter must first assess whether the requested deviation is permissible under the firm's authority and regulatory framework. If it is, the underwriter must then ensure that all necessary disclosures are made to the client, that the client understands and agrees to the altered terms, and that this agreement is properly documented. If the deviation is not permissible, or if the client cannot be adequately informed, or is unwilling to accept the risks, the underwriter must be prepared to decline the business, explaining the reasons clearly. This structured approach ensures compliance, protects the client, and safeguards the firm. Question 15. The review process indicates that a proposal has been received for hull and liability insurance for a newly acquired, mid-sized turboprop aircraft intended for charter operations within Europe. The broker has provided a standard proposal form, but has not included detailed operational plans or maintenance schedules. Which approach best aligns with London market underwriting principles and regulatory expectations for this scenario? Option A. Apply a significant loading to the premium to cover the perceived uncertainty arising from the incomplete information provided by the broker. Option B. Decline the risk outright due to the lack of detailed operational and maintenance information, citing insufficient data for underwriting. Option C. Request detailed operational plans, maintenance records, pilot qualifications, and a clear definition of the intended operational territory before quoting terms. Option D. Issue a standard hull and liability policy based on the broker's proposal, assuming charter operations within Europe are a common risk. The correct answer is D. Issue a standard hull and liability policy based on the broker's proposal, assuming charter operations within Europe are a common risk. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for comprehensive coverage for a complex aviation risk with the regulatory imperative to ensure that policies are not written in a way that could lead to regulatory breaches or market instability. The specific nature of aviation insurance, with its inherent high values, potential for catastrophic loss, and international scope, demands meticulous attention to detail and adherence to established underwriting principles and regulatory guidance. The underwriter must exercise sound judgment to assess the risk accurately and price it appropriately, while also ensuring compliance with the London market's regulatory framework, which emphasizes fair treatment of customers market integrity, and solvency. The correct approach involves a thorough review of the aircraft's operational history, maintenance records, pilot qualifications, and the proposed operational territory. This detailed risk assessment allows the underwriter to identify specific exposures and tailor coverage accordingly, ensuring that the policy accurately reflects the risk being insured. This aligns with the principles of prudent underwriting and the regulatory expectation that insurance contracts are based on a clear understanding of the risk. Specifically, it upholds the principles of underwriting as outlined in the London Market Underwriting Principles exam, which stress the importance of accurate risk assessment and the provision of appropriate cover. This approach ensures that the policy is both commercially viable for the insurer and provides adequate protection for the insured, without creating unforeseen liabilities or regulatory issues. An incorrect approach would be to automatically apply a standard hull insurance policy without considering the specific operational details of the aircraft. This fails to adequately assess the risk, potentially leading to underpricing and inadequate reserves, which could impact the insurer's solvency and contravene regulatory requirements for prudent financial management. Another incorrect approach would be to exclude coverage for all potential third-party liabilities, even those that are standard in aviation insurance. This would not only be commercially unviable, but also likely contravene regulatory expectations regarding the provision of fair and comprehensive insurance products, potentially leading to market dissatisfaction and regulatory scrutiny. A third incorrect approach would be to rely solely on the broker's initial proposal without independent verification of the aircraft's airworthiness or the insured's operational procedures. This abdication of underwriting responsibility is a direct breach of the duty of care and the regulatory expectation that underwriters conduct their own due diligence. The professional decision-making process for similar situations should involve a systematic risk assessment framework. This includes gathering all relevant information, identifying potential hazards and exposures, evaluating the likelihood and severity of potential losses, and determining appropriate terms, conditions, and pricing. It also necessitates a thorough understanding of the applicable regulatory framework and market best practices. When in doubt, seeking advice from senior underwriters, technical specialists, or legal counsel is crucial to ensure that decisions are well-informed and compliant. Question 16. The performance metrics show a significant increase in claims frequency for a particular class of business over the last 2 years. The underwriting team is considering adjusting rates for this class. Which of the following approaches best aligns with London market underwriting principles and actuarial best practices for rate making? Option A. Implement a modest rate increase that is unlikely to deter new business, focusing on a qualitative assessment of the increased claims frequency rather than a quantitative actuarial projection. Option B. Match the rate increases implemented by key competitors in the London market for similar classes of business, assuming their pricing reflects current market conditions. Option C. Apply a rate increase based on a trend analysis of the increased claims frequency, using a generalized linear model to project future claims costs and incorporating a buffer for increased volatility. Option D. Reduce the rate for this class to attract more volume, believing that the recent claims increase is a temporary anomaly and that increased premium income from higher volumes will offset potential losses. The correct answer is C. Apply a rate increase based on a trend analysis of the increased claims frequency, using a generalized linear model to project future claims costs and incorporating a buffer for increased volatility. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for competitive pricing with the regulatory imperative to ensure rates are not unfairly discriminatory and are based on sound actuarial principles. The London market operates under a stringent regulatory environment, primarily governed by the Financial Conduct Authority, FCA, and Lloyd's market rules, which emphasize fairness, transparency, and solvency. Misinterpreting or misapplying actuarial principles can lead to underpricing, impacting profitability and solvency, or overpricing, leading to market disadvantage and potential unfair discrimination. The correct approach involves a thorough understanding and application of the chosen rate-making methodology, ensuring it aligns with the underlying risk and is supported by robust actuarial data. This methodology must be demonstrably fair and not lead to discriminatory outcomes, as mandated by FCA principles, and Lloyd's market guidance on fair treatment of customers and responsible pricing. The underwriter must be able to articulate the rationale behind the rate, demonstrating its actuarial soundness and compliance with regulatory expectations regarding data sufficiency and the appropriateness of the chosen statistical methods. An incorrect approach would be to rely solely on market precedent or competitor pricing without independent actuarial validation. This fails to meet the regulatory requirement for rates to be based on sound actuarial principles and can perpetuate potentially flawed pricing structures. It also risks unfair discrimination if competitor pricing is not based on a sound understanding of the risk. Another incorrect approach is to use a methodology that is overly simplistic or does not adequately account for the specific risk factors of the insured, leading to rates that are either inadequate to cover claims or unfairly punitive. This demonstrates a lack of due diligence and a failure to adhere to the principles of actuarial science and responsible underwriting. A further incorrect approach would be to ignore emerging trends or new data that might invalidate the assumptions of the chosen rate-making methodology, thereby failing to maintain actuarial integrity and potentially exposing the insurer to unforeseen losses. Professionals should employ a decision-making framework that prioritizes regulatory compliance and actuarial soundness. This involves 1. Understanding the specific risk profile of the insured and the relevant market conditions. 2. Selecting a rate-making methodology that is appropriate for the risk and data available, ensuring it is actuarially defensible. 3. Critically evaluating the output of the chosen methodology, considering its implications for fairness, competitiveness, and solvency. 4. Documenting the rationale for the chosen rate and methodology, including any deviations from standard practice, and being prepared to justify these decisions to regulators and stakeholders. Question 17. Assessment of the underwriting approach for a large, aging tanker, considering a request from a long-standing broker to renew the hull and machinery insurance with minimal changes to the existing terms and premium, despite recent reports of increased maintenance costs and a shift in the vessel's trading pattern to more challenging waters. Option A. Renew the policy with the existing terms and premium, as requested by the broker, to maintain the relationship and secure the business. Option B. Rely primarily on the historical premium levels and the broker's assurance that the vessel remains a good risk, making only minor adjustments to the terms. Option C. Conduct a comprehensive review of the vessel's current condition, maintenance history, crew qualifications, and the specific risks associated with the new trading patterns, adjusting terms and premium accordingly to reflect the updated risk profile. Option D. Accept the broker's proposed terms and premium, but add a rider clause to exclude coverage for any losses arising from the vessel's new trading patterns. The correct answer is C. Conduct a comprehensive review of the vessel's current condition, maintenance history, crew qualifications, and the specific risks associated with the new trading patterns, adjusting terms and premium accordingly to reflect the updated risk profile. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need to accurately assess risk for a complex marine asset with the potential for market pressures to influence underwriting decisions. The underwriter must navigate the inherent uncertainties of hull and machinery insurance, including the potential for catastrophic losses and the long-term nature of the asset's operational life. The challenge lies in applying sound underwriting principles and adhering to regulatory requirements without succumbing to undue influence that could compromise the integrity of the underwriting process or the financial stability of the insurer. The correct approach involves a thorough and objective assessment of all relevant risk factors, including the vessel's operational history, maintenance records, crew competence, trading patterns, and the specific terms and conditions of the proposed insurance cover. This approach aligns with the fundamental principles of prudent underwriting, which are implicitly and explicitly supported by regulatory frameworks such as those overseen by the Prudential Regulation Authority, PRA, and the Financial Conduct Authority, FCA, in the UK. These regulators expect insurers to maintain robust risk management systems and to underwrite business in a manner that ensures solvency and protects policyholders. Specifically, the FCA's principles for businesses, particularly Principle 3, Customers' Interests, and Principle 8, Risk Management, and the PRA's Solvency Roman II requirements, mandate that firms conduct their business with due skill, care, and diligence, and manage risks effectively. An objective assessment ensures that premiums accurately reflect the risk, thereby safeguarding the insurer's financial health and its ability to meet future claims, which is a core regulatory expectation. An incorrect approach that prioritizes securing the business at any cost, even if it means accepting terms that do not adequately reflect the risk, fails to meet regulatory expectations. This could lead to underpricing of risk, potentially resulting in financial losses for the insurer and impacting its solvency. Such an approach would contravene the FCA's Principle 3 by not acting in the best interests of customers, as it could lead to future premium increases or reduced coverage if the insurer faces financial difficulties, and would violate the PRA's Solvency Roman II requirements for adequate capitalization and risk management. Another incorrect approach that relies solely on historical premium levels without a current, detailed risk assessment is also professionally unacceptable. While historical data is valuable, it does not account for changes in the vessel's condition, operational environment, or emerging risks. This oversight could lead to inadequate pricing and a failure to manage risk effectively, again potentially breaching regulatory requirements for prudent underwriting and risk management. A further incorrect approach that involves accepting the broker's proposed terms without independent verification or challenge, particularly if the broker is perceived as having significant influence, demonstrates a lack of due diligence. This can lead to a failure to identify or mitigate potential risks, thereby exposing the insurer to unacceptable levels of exposure and contravening the FCA's Principle 8 and the PRA's expectations for robust internal controls and risk assessment processes. The professional decision-making process for similar situations should involve a structured risk assessment framework. This includes clearly defining the scope of the risk, gathering all relevant information, objectively evaluating the identified risks, determining appropriate terms and pricing based on the risk assessment, and documenting the rationale for the underwriting decision. Underwriters should be empowered to challenge proposals and seek further information when necessary, and their decisions should be defensible against regulatory scrutiny. The ultimate goal is to underwrite profitably and sustainably, ensuring the long-term viability of the insurance operation and fulfilling regulatory obligations. Question 18. Upon reviewing a proposal for business interruption and consequential loss insurance for a niche manufacturing firm, which approach to risk assessment would best align with the principles of sound underwriting in the London market, considering the potential for operational disruption beyond direct physical damage? Option A. A primary focus on historical financial statements to project future earnings, assuming a direct correlation between past performance and future business interruption claims. Option B. An assessment heavily weighted toward the probability of extremely rare, catastrophic events, with less emphasis on more common, yet disruptive operational failures. Option C. A detailed analysis of the insured's supply chain dependencies, customer concentration, and the estimated time required for operational recovery following various insurable perils, alongside a review of their historical financial performance. Option D. The application of a standard, predefined business interruption, wording without specific consideration for the unique operational characteristics of the manufacturing firm. The correct answer is C. A detailed analysis of the insured's supply chain dependencies, customer concentration, and the estimated time required for operational recovery following various insurable perils, alongside a review of their historical financial performance. Explanation. This scenario is professionally challenging because accurately assessing the potential for business interruption and consequential loss requires a nuanced understanding of both the insured's operations and the specific perils that could disrupt them. It demands more than simply quantifying historical financial data. It necessitates foresight and an appreciation for the interconnectedness of business processes. The underwriter must consider not only direct physical damage, but also the cascading effects on supply chains, customer access, and the ability to resume operations, all within the context of the London market's established principles and regulatory expectations. The correct approach involves a thorough, forward-looking risk assessment that considers the insured's specific business model, operational dependencies, and the potential impact of various perils on their ability to generate revenue. This includes understanding their supply chain vulnerabilities, customer base concentration, and the time it would realistically take to resume operations following a covered event. This approach aligns with the London market's emphasis on informed underwriting, where premiums are reflective of the assessed risk. It also adheres to regulatory expectations that insurers conduct due diligence to ensure policies provide appropriate cover, and that premiums are fair and not unduly influenced by incomplete or speculative analysis. The principle of utmost good faith, fundamental in insurance, requires the underwriter to make a reasonable assessment of risk based on available information and sound judgment. An incorrect approach that relies solely on historical financial data without considering future operational vulnerabilities fails to adequately assess the true risk. This can lead to underpricing the cover, potentially exposing the insurer to losses beyond what was anticipated and priced for. It also risks providing inadequate cover to the insured, failing to meet their reasonable expectations, and potentially breaching the duty of care. Another incorrect approach that overemphasizes the likelihood of a specific, rare peril without a balanced consideration of more probable, yet still disruptive, events demonstrates a flawed risk perception. This can lead to either excessive premium loading for an unlikely event or, conversely, insufficient consideration of the cumulative impact of more common disruptions. This deviates from the principle of proportionate risk assessment and can result in mispriced business. A further incorrect approach that applies a generic business interruption clause without tailoring it to the specific operational nuances of the insured business is also professionally unsound. Business interruption is not a one-size-fits-all product. Failing to understand the insured's unique operational dependencies and potential points of failure means the cover may not respond effectively when a claim arises, leading to disputes and reputational damage for the market. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with a deep dive into the insured's business operations, identifying critical dependencies and potential points of failure. It then involves evaluating the likelihood and potential impact of various perils, considering both direct and indirect consequences. This information should then be used to determine appropriate coverage terms, conditions, and premium levels, ensuring alignment with the insured's needs and the insurer's risk appetite, all while adhering to regulatory requirements and market best practices. Question 19. Process analysis reveals that a London market underwriter is reviewing a proposal for a new offshore wind farm installation project. The project involves the transportation of prefabricated turbine components from a fabrication yard to the offshore site and their subsequent assembly and erection onto pre-installed foundations. The underwriter is considering whether to offer a standard construction all-risks CAR policy or an erection all-risks EAR policy, which approach best aligns with the principles of accurate risk assessment and appropriate coverage for this specific project phase. Option A. Offer an erection all-risks EAR policy, as it specifically covers the risks associated with the assembly and installation of components on site, which is the primary focus of this project phase. Option B. Recommend a standard marine cargo policy for the transportation phase and a separate property damage policy for the erection phase, as these are distinct risks. Option C. Propose a bespoke policy that excludes all risks related to transportation and focuses solely on the erection phase, as this is the most critical element. Option D. Offer a construction all-risks CAR policy, as it provides the broadest coverage and is generally applicable to all types of construction projects, ensuring no gaps in protection. Correct answer is A. Offer an erection all-risks EAR policy, as it specifically covers the risks associated with the assembly and installation of components on site, which is the primary focus of this project phase. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the need for comprehensive coverage for a complex construction project with the practicalities of risk assessment and premium calculation, all within the specific regulatory environment of the London market. The distinction between construction all-risks CAR and erection all-risks EAR is crucial, as is understanding the scope of each. Misinterpreting these can lead to underinsurance, coverage gaps, or an uninsurable risk, all of which have significant financial and reputational implications for both the insured and the insurer. Careful judgment is required to ensure the policy accurately reflects the project's risks and complies with market best practices and regulatory expectations. The correct approach involves accurately identifying the project's specific needs and aligning them with the appropriate policy wording. For a project involving the assembly and installation of prefabricated components on site, an erection all risks (EAR) policy is generally more suitable. EAR policies are specifically designed to cover risks associated with the erection, assembly, and installation of machinery, plant, and structures. This approach is correct because it provides targeted coverage for the unique risks inherent in the erection phase, such as faulty workmanship during assembly, collapse of temporary structures, and damage during lifting operations. It avoids the broader and potentially unnecessary scope of a CAR policy, which typically covers the entire construction process from site preparation to completion, including civil engineering works and the building itself. Adhering to this distinction ensures that the premium is commensurate with the actual risks being covered, and that the policy terms are clear and unambiguous, aligning with the principles of good underwriting and regulatory expectations for fair representation of risk. An incorrect approach would be to automatically apply a construction all risks CAR policy without a detailed assessment of the project's specific phase and nature. This is professionally challenging because while CAR is a broad policy, it may not be the most efficient or accurate solution for a project primarily focused on erection. The regulatory failure here lies in potentially misrepresenting the scope of cover and the associated premium. A CAR policy might include cover for elements not relevant to the erection phase, leading to an inflated premium, or, conversely, might not adequately address the specific risks of erection if its focus is on broader construction activities. This lack of precision can lead to disputes and claims handling issues, potentially breaching regulatory requirements for clarity and fairness in insurance contracts. Another incorrect approach would be to offer a bespoke policy that deviates significantly from standard CAR or EAR wordings without robust justification and clear articulation of the altered scope. While flexibility is a hallmark of the London market, significant deviations must be meticulously documented and understood by all parties. The regulatory and ethical failure here is the potential for creating an uninsurable risk or a policy that is not understood by the insured, leading to potential non-disclosure or misrepresentation at the claims stage. This undermines the principle of utmost good faith and can result in regulatory scrutiny for inadequate risk assessment and policy documentation. The professional decision-making process for similar situations should involve a thorough understanding of the project's life cycle, the specific activities undertaken, and the inherent risks at each stage. Underwriters must leverage their expertise to determine the most appropriate policy type, whether it be CAR, EAR, or a combination thereof, or even a more specialized wording if necessary. This requires detailed consultation with the insured and their representatives, a comprehensive review of project plans and specifications, and a clear understanding of market wordings and their applicability. Regulatory compliance is achieved by ensuring that the chosen policy accurately reflects the risk, is clearly explained to the client, and that the premium is fair and justifiable. The principle of utmost good faith must guide all interactions, ensuring transparency and honesty throughout the underwriting process. Question 20. Performance analysis shows that a significant number of claims in the professional indemnity sector are now being settled based on interpretations of liability that were not prevalent at the inception of older policies. In light of this trend, which approach best balances the underwriter's duty to protect the client's legal liabilities with the insurer's need for prudent risk management and adherence to regulatory principles? Option A. Renew the policy with the existing wording, assuming historical claim patterns will continue and that the insurer's reserves are adequate for unforeseen developments. Option B. Increase the premium significantly across all professional indemnity policies to create a larger buffer for potential future claims, without specific underwriting adjustments to individual risks. Option C. Immediately implement a blanket exclusion for any liabilities arising from evolving legal interpretations or societal expectations, without specific analysis of the client's operations. Option D. Conduct a comprehensive review of the policy wording. Assess the impact of recent case law and legislative changes on potential liabilities for the client's profession, and propose updated wording or endorsements to reflect current risk realities, with clear communication to the client and broker. The correct answer is A. Renew the policy with the existing wording, assuming historical claim patterns will continue and that the insurer's reserves are adequate for unforeseen developments. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for comprehensive coverage for a client with the insurer's obligation to underwrite risks prudently and in accordance with regulatory requirements. The underwriter must assess the potential for future claims arising from evolving legal interpretations and societal expectations, which are inherently uncertain. Careful judgment is required to ensure the policy provides adequate protection without exposing the insurer to unquantifiable or excessive liabilities, all while adhering to the principles of fair representation and good faith expected in the London market. The correct approach involves a thorough review of the policy wording and the client's specific operations, coupled with an understanding of current and emerging legal trends relevant to the industry. This includes considering the potential impact of new legislation, landmark court decisions, and shifts in public policy that could broaden the scope of liability. The underwriter should then engage in clear and transparent communication with the client and their broker to discuss the identified exposures and the proposed coverage, ensuring all parties understand the policy's limitations and the rationale behind them. This aligns with the principles of prudent underwriting and the regulatory expectation that insurers manage their risks effectively and provide clear, understandable policy terms. It also upholds the duty of utmost good faith by ensuring the client is fully informed about the coverage they are purchasing. An incorrect approach would be to simply renew the policy with minimal changes based on historical data, without considering the evolving legal landscape. This fails to meet the underwriter's duty to prudently assess and price risk, potentially exposing the insurer to claims that were not contemplated or priced for. It also breaches the principle of utmost good faith by not proactively informing the client of potential coverage gaps arising from external factors. Another incorrect approach would be to significantly restrict coverage without adequate justification or clear communication to the client. While insurers must manage their exposure, arbitrary or poorly explained reductions in coverage can lead to disputes and a failure to meet the client's reasonable expectations of protection, potentially contravening regulatory guidance on fair treatment of customers. A third incorrect approach would be to offer broad, unqualified coverage for all future liabilities, regardless of their nature or origin. This demonstrates a lack of risk assessment and underwriting discipline, exposing the insurer to potentially unlimited and unmanageable liabilities, which is contrary to the fundamental principles of insurance and regulatory requirements for solvency and prudent financial management. The professional decision-making process for similar situations should involve a structured risk assessment that considers not only the client's current operations, but also the external environment. This includes staying abreast of legal and regulatory developments, consulting with legal experts where necessary, and engaging in proactive dialogue with brokers and clients to ensure alignment on risk appetite and coverage expectations. Transparency and clear documentation of the underwriting rationale are paramount.